Welcome to GRE. I'm your host, Keith Weinhold. The naming of a new Federal Reserve Chair, then are home builders in trouble today? There are a dwindling number of them, and their profits are down. I'll talk to a home builder, listen to what amenities tenants want today, and it's interesting. We'll learn how low of a mortgage rate builders will give you now. There's an opportunity here today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
Mid-South homebuyers with over 2 decades as the nation's highest-rated turnkey provider, their empathetic property managers use your return on investment as their North Star. It's no wonder smart investors line up to get their completely renovated income properties like it's the newest iPhone. Headquartered in Memphis with their globally attractive cash flows, Mid-South has an A-plus rating with the Better Business Bureau and 4,000 houses renovated. There is zero markup on maintenance, let that sink in, and they average a 98.9% occupancy rate with an industry-leading 3.5-year average renter term. Every home they offer you will have brand new components, a bumper-to-bumper 1-year warranty, new 30-year roofs, and wait for it, a high-quality renter in an astounding price range, $100,000 to $150,000. Get to know Mid-South. Enjoy cash flow from day one at midsouthhomebuyers.com. That's midsouthhomebuyers.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Coudersport, Pennsylvania to Davenport, Iowa, and across 188 nations worldwide. I'm Keith Weinhold, and you are listening to Get Rich Education. Now, more than ever, where you learn about personal finance and real estate investing matters. There's more AI-generated content out there. This show is all flesh and blood me. There's also more clickbait content out there that says something like, the housing market is about to have a price crash. No, it's not. They're just there to get short-term attention. So your information source really matters today. New incoming Fed Chair Kevin Warsh was recently named. He will replace the outgoing Jerome Powell on May 15th. I want to tell you more about that in a moment. But first, just imagine if this scenario were to occur. Say that we get a Fed chair that has to deal with really high inflation. And so what this Fed chair does is that he successfully brings inflation down, and he does that without triggering a recession. That's called a soft landing. Well, you know what? That's exactly what Jerome Powell did the past 3 years. Yeah, that's what he's accomplished. And he doesn't get credit for it. He only gets a lot of criticism. Now, this doesn't mean that I love Powell. I don't even know that the Fed should exist at all. But Powell got a lot of criticism for calling 2022's wave of inflation transitory and being too late to respond to it. So he gets some credit here. As his term of more than 8 years winds down, let's listen into some of Jay Powell's recent comments about succession.
You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Honestly, I'd say a couple of things. One is stay out of elected politics. Don't get pulled into elected politics. Don't do it. And that's another thing. Another is that, our window into democratic accountability is Congress. And it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers. And so it's something you need to work hard at, and I have worked hard at it. So, and the last thing is, it's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
Yeah, so to Powell's point, the next Fed chair, Warsh, does champion Fed independence, much like Powell has. That is a good thing. That keeps America from turning into a banana republic that maintains a strong dollar. Warsh was actually a Fed governor back during the 2008 global financial crisis, so he's got that experience. When he comes in as Fed chair in 3 months, he's widely expected to lower interest rates more than Powell did, much like the president wants. Kevin Warsh looks a lot like Michael Scott from The Office. He has got to be less bumbling than him, though. Overall, the effect on real estate and mortgage rates by shifting from Powell to Warsh, that should be pretty mild. Maybe you'll see rates go a little lower than if Powell had stayed. And speaking of rates, wait till you see how low the mortgage rate is that our homebuilder guest is offering today. What's really happening with homebuilders now? How much trouble are they in? Homebuilders have largely been maligned. Overall, there are fewer homebuilders today in America than there were 20 years ago, and there are more remodelers than there were 20 years ago. Fewer homebuilders, more remodelers, and that's for a few different reasons. Over the past couple decades, we just have substantially higher labor and material costs, stricter building and energy codes, higher interest rates, and that disproportionately hurts long-duration construction projects. We've got zoning constraints and land constraints that make ground-up development slow and uncertain and risky. So while the number of home builders in America is down, the number of remodelers are up because America's housing stock is getting older. Its median age is over 40 years, and that creates constant demand for upgrades. Capital prefers faster, lower risk cycles. That's what remodels offer. And homeowners with locked-in low mortgage rates choose to stay in place. And what does that make them do? That makes them renovate and remodel, not move. So this is why, compared to 20 years ago, you have fewer home builders and more remodelers today. That's per the NAHB and the Census Bureau. And all these forces, they've resulted in a lower profit margin for home builders. Yes, home builder margin compression for a lot of the bigger builders, including D.R. Horton, just as you might guess, in this cycle, their profits were greatest in 2022, and they have fallen since then. Higher mortgage rates came in, and builders had to lose profits by offering more incentives to entice buyers. You're going to learn more about that today and how it really spells quite an opportunity for you and I. When the final change in national home prices was tallied for the end of last year, they had risen in 16,500 zip codes. All right, that's 63% of America's zip codes, and prices were lower from a year earlier in the other 37%. Home price gains were concentrated in the Northeast and Midwest, and the story there continues to be too many buyers and not enough homes. In fact, over 85% of zip codes saw price growth in Illinois, Connecticut, Wisconsin, and Indiana. Slow, steady, stubborn, kind of like winter refusing to leave. Losses were predominant in the Sun Belt. Prices caught their breath there. There was price attrition in Florida with 96% of zip codes, so nearly all of Florida then. California, 78% of zip codes had a price loss. Texas, 75% of them. And Arizona, 73%. The biggest pocket of opportunity appears to be in Florida. Florida property is on sale. And because real estate is local, a lot of times we talk here nationally, but to get to that local level, sometimes you have to dig in to a local market to really find out what's going on. We're going to do that today. Now, central Miami, Orlando, and Tampa, they're not generally the spot for obtaining cash flow from long-term rentals. I've identified an opportunity. We'll get into that with this Florida home builder shortly. It's kind of funny. You'll run into people that say they want opportunity, but what they really want is certainty. How it plays out, though, is that once the certainty arrives, the opportunity is gone. And that's how to think about Florida and maybe Texas and some of these other markets today that have had price attrition. Now, 3 weeks ago here on the show, I discussed the 721 exchange for the first time, so I won't get into all those details again. When it comes time for you to sell your investment property, the 721 can be the best way for you to cash out. Perhaps you've been investing in real estate for a while and you have turned get-rich education into got-rich education. How the 721 exchange works is that basically, say you have a case where you're a rental property owner and you realize that you don't want the hassles of landlording anymore. Oftentimes this can mean you're older and real estate investing already took you where you wanted it to take you in life's journey, but you still like the financial benefit that ownership gives you. What you can do is exchange your properties into a partnership and receive shares in that partnership. Now, that's different than a 1031 exchange. That's where you trade up some of your property that you directly own for what's usually more and larger property that you directly own. Well, instead, here's the big deal. With exchanging your properties into a 721 partnership, the rules stipulate that this is not a taxable event, and therefore you don't have to pay any capital gains tax or depreciation recapture. Now that you're an owner in the partnership, you still get some of the benefits of owning the property, like appreciation and cash flow and such, yet no management or landlording at all, like you would have with a 1031. And with a 721, you get all these benefits across a greater number of properties and markets. Diversification, because you're a fractional owner in the other properties that are in the partnership, not only your own. And when you eventually pass away, your shares are stepped up in basis and can be distributed equally to heirs. And see, it's surely easier for you to divide shares among, say, your 3 children than it is to divide your 18 rental houses among 3 children who are going to have different goals and varying degrees of financial savvy. So the 721 exchange is a great estate planning tool too. You will have this partnership that makes an offer to buy your property. You're exchanging them for partnership shares. There's a firm that does this called Flock Homes, and they have a certain buy box. To be clear, with the 721 exchange, you can basically trade your rentals for shares in a diversified, professionally managed real estate fund. This means that you keep your hard-earned equity, defer capital gains and other taxes, and you still get access to steady income and long-term appreciation without the hassle of landlord duties. And you can visit flockhomes.com/GRE and get a free valuation. Get an offer for your property, see if it fits their buy box, and see how much they'll pay you. There's often no need to pay to fix up or stage the property for sale or pay agent commissions. For a certain investor type, this really can be a rather life-changing experience for you to liquidate some or all of your property, have zero tax obligation, and still enjoy income and appreciation. So again, what you can do is stop by flockhomes.com/GRE. That's FLOCK homes.com/GRE. Let's discuss the home building climate today. I'd like to bring in a premium Florida home builder guest to the show, Jim, because there's been more home building in Florida such that some areas of the state have excess supply. And when you add that onto the fact that the hot pandemic migration to Florida has slowed such that home prices have made a rare dip in the state, That's why it's a timely topic. Jim, you're on GRE. Welcome to the show.
Keith, great to be here. Thanks for having me.
Yeah, and we did the IRL thing in Colorado there a few weeks ago. That was great, hanging out in person. You provide entry-level new build homes, mostly in Central Florida, and these are properties that are conducive to real estate pays five ways. These are properties that investors chiefly buy as rentals. So just bigger picture, tell us about that overall experience over, say, the last 5 years as the pandemic wound down.
Yeah, as the pandemic wound down, obviously Florida had a lot of attention, some of it rightly so, some of it, I think, a little more inflated and commercial attention getting thrown at it. And, the type of deals that you and I have always stayed away from were very popular in Florida. We're talking really nice houses, Keith, beautiful, nice HOAs. People got in 2021, let's say, with those very low interest rates on a $600,000 or $700,000 home. But now they're realizing that it's not going up $100,000 a year as they thought. And when they try to sell it, well, people trying to buy a $700,000 home, they're not getting that low interest rate. And if these people try to hold it and rent it, well, it doesn't cash flow. So it breaks one of those rules. It's not putting money in people's pockets, it's taking it out. And so we're seeing there was a large distribution of those types of houses around Florida. And then there were some builders like us that really focused on what was the most needed, and that was workforce housing. Now, workforce housing, though, Keith, as you know, a lot of the builders don't want to build it. Why? Let's be straight. It's because the margins are lower. Right. But as you know, with me and my partner, Chris, it was always, let's make less margin and do more volume. That was always our model. And that was the area of the market where we felt we could build it right, we could get it financed right, and we could manage it right to hit the five things. And so we're seeing today, post-pandemic, there are still key markets where the population growth is still the highest coming into Florida. The prices are still the lowest, and there is a shortage of this type of workforce housing.
Yes, you've identified a geography within Florida that have some of these characteristics like you're talking about. Tell us more about that region.
Yeah, we call it the Ocala region. So Central Florida, just west of Orlando. Right now, for example, U-Haul does their U-Haul top markets rankings every year. So where are the most U-Haul trucks going to? Now, you don't want to be on the other side where they're coming from, Keith, because that's obviously the opposite. But for the second year in a row, the greater Ocala area has been the number one U-Haul destination place in the country. So there's still a ton of population growth going there. Central Florida, I'm not going to say it sat out the growth during the pandemic that a lot of areas of Florida did, but it was starting at such a low basis with such a small amount of attention that today, even when people say, oh gosh, like I just said, houses, 600, 700, 800,000, we're building new construction single-family homes for under 300,000, the 270s a lot of the time, and we're building duplexes sometimes for under 400,000. And a lot of our, investors coming from the West Coast say, are these fully built? Are they? But again, Central Florida has had a great affordability remain intact. It has a large population going in. There is a ton of job resource just blowing up in the area. And as you know, these are the things we look for. So we bought a lot of lots there. I'm going to give credit to my partner, Chris. He saw Ocala more than I did. And we bought a lot of lots there in 2020. So before all the rises, so we got into the land basis right. So that means we can build them at a great price. Our land basis is low, and that obviously passes along to our clients. And again, Central Florida is a perfect match for our goal because our goal is workforce housing that cash flows on day one, but also nothing wrong with fixer-uppers. I own a lot. I used to do a lot, but the new construction seems to have a little bit more of a less involvement, which it seems like a lot of our clients want.
That was really prescient as it turned out for your business partner, Chris, there to gobble up a lot of that land in 2020 before prices went soaring. And this is one reason why you can do things like offer a duplex for less than $400K that's a new build, which has some people saying, like, does that thing include a roof even? But it surely does. These are very good quality, livable properties. And the reason I have you here, Jim, is because you are rare. There are fewer builders today than there were in decades past. And also, those that build, to your point earlier, they only want to build higher end properties, not the more affordable ones that you offer. We'll get more details on your price points and what products you offer later. But yeah, we have more remodelers today and fewer builders. And though it's a few years old, I found it interesting that census statistics show us that between 2007 and 2022, there are 73% more remodelers and 21% fewer builders today.
Interesting. Keith, I didn't know that. And that makes me scratch my head on, like when you and I were in Colorado, we were talking about future needs. Even with growth that occurred during the pandemic, going all the way back to '08 when a real shortage started to start, we are still at an estimated 3 to 5 million homes short in the U.S. It really perplexes me that the amount of builders like us will be going down and not actually entering the market.
Now, among those that are building, though, much of that is concentrated in the South, as I think we know. There's a recent Resi Club compilation showed that 59% of current single-family home building is in the South and 41% is everywhere else. And how do you define the South? That's basically Maryland down to Florida, all the way out to Texas and Oklahoma. So you are pretty rare in some ways. However, where you're building regionally, that's not a rarity there. But yeah, having more remodelers today and fewer home builders, that's probably the result of a lot of things. For one thing, just land and construction costs becoming that much more expensive over the past 5 years.
Yeah, we've been lucky too. As you know, Keith, you've been with us for a decade now, but when we transitioned a piece of our company where Sumitomo Forestry, large Japanese group, stepped in and acquired a piece of our property, that was a very exciting thing for all of us together because we had done well and, started small and built up to a decent sized builder for Northeast Florida and then the rest of Florida. But now with Sumitomo coming in, again, they build 17,000 homes worldwide every year between all of their builders. Now being a part of them, we get to use their national material accounts. So they get pricing just as good, if not better than national home builders. And they let us do our thing, stick to our build to rent, working with investor clients. We're not retail buyer guys, really. We like working with our investors. But just getting those great discounts on materials, again, we're always looking to pass on savings to our clients. Of course, we got to make margins as well. But if we're getting in with deals like that, getting into the land right, and knowing the pinpointed areas to get into, we can get the best deal for everyone. And that's been a major part, having such a big, successful partner like Sumitomo keep us healthy, viable, and able to do things we could have not even dreamed of 5 years ago.
Yes, that gives you more capital and more options. Another unusual aberration in the market that really centers on a lot of what you do is that this fact that, and this was mentioned on the show last year, for the first time in my life, existing homes cost more than new build homes. Existing homes at about $420K nationally, and new build homes about $392K. Part of the divergence there is probably builder price cuts. So tell us more about that.
I think the issue, Heath, is builders built for largest spreads and people bought very emotionally. I think you're, to give you a compliment, a very unemotional real estate buyer. You're not looking at, oh, this is a very nice, extra his and hers porcelain sink. And we're looking at fundamental numbers of good, solid property. And I think what's caused a lot of that is people did the opposite. Builders were looking for the largest margin they could get, which was on those types of properties. And then buyers were looking very emotionally, and they were told, hey, this is going to go up $50,000 to $100,000 a year. So just sit there and hold on. Sure, you'll lose $1,500 a month, but don't worry about it. You'll make up for that every year. And obviously, we're not seeing that's true. They could have really used your class about the 5 ways to get paid in real estate. And I think that that's what's doing it. And this is what builders do. I mean, everyone's in a business and a lot of builders just focus on the largest margin. Now that's eating them up now because those types of properties are not in demand. To build them on spec would be very dangerous. But you can see that worked for a short term. We're very glad we went to the low margin workforce housing model because I see that falling out of favor almost never. Even in 08, 09, Keith, when I was in the remodel game, a lot of the properties that were new construction coming out that time, if they were affordable, still did very well.
We're talking with a premium Florida home builder today because they offer affordable properties that make sense for investors. But what about the demand? Where is that going to come from? Where is that going to be? And that's what's happening with the renter segment. We'll talk more about that when we come back. You're listening to Get Rich Education. I'm your host, Keith Weinhold. Flock Homes helps you retire from real estate and landlording, whether it's one problem property or your whole portfolio, through a 721 exchange, deferring your capital gains tax and depreciation recapture. It's a strategy long used by the ultra-wealthy. Now, mom and pop landlords can 721 their residential real estate. Request your initial valuation. See if your properties qualify at flockhomes.com/GRE. That's FLOCKhomes.com/GRE. You know, most people think they're playing it safe with their liquid money, but they're actually losing. Savings accounts and bonds don't keep up when true inflation eats 6 or 7% of your wealth every single year. I invest my liquidity with FFI, Freedom Family Investments, in their flagship program. Why? Fixed 10 to 12% returns have been predictable and paid quarterly. There's real-world security backed by needs-based real estate like affordable housing, senior living, and healthcare. Ask about the Freedom Flagship Program when you speak to a Freedom coach there. And that's just one part of their family of products. They've got workshops, webinars, and seminars designed to educate you before you invest. Start with as little as $25K and finally get your money working as hard as you do. Get started at freedomfamilyinvestments.com/GRE or send a text now. It's 1-937-795-8989. Yep, text their Freedom Coach directly. Again, 1-937-795-8989. The same place where I get my own mortgage loans is where you can get yours. Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com.
This is Rich Dad Advisor Ken McElroy. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold. We're talking with Jim, a premium Florida home builder here at such an interesting time in the cycle since supply is up in some parts of Florida. Jim and his team has strategically chosen a place that is still fueling a lot of net in-migration in Central Florida, and that's where the rental demand needs to come from as well. Now, nationally, we've seen the home ownership rate fall over about the past year from near 66% to near 65%. That does not sound like much, but a 1% shift means there are 1.3 million new renters in just the past year. So with that in mind, and the fact that this low affordability for home buying means that people need to rent or stay renters longer, provides some of this sustainable demand. So tell us more about the rental demand in Central Florida.
Yeah, you know, when we first went out there about a decade ago, Keith, I think it was 82 or 83% of all properties out there were owner-occupied. Yeah, which means it was a very lopsided amount of existing rental property available. And this is before the curve of population growth really took off. But when Chris and I went out there and we were assessing that small percentage of rental property that was out there, gosh, it was old and kind of beat up. There was not a lot like the new construction that was available. So when we brought in new construction, we saw just the competition was hard to compete with us. You know, when it was an older, not so nice taken care of, we came in and we saw a jump from, doing older houses ourselves. A person would stay about 13 months. But for the new construction in Central Florida, we've seen a jump to about 3 years. So that's really positive. People get into a new construction property. They don't want to leave, whether that's half of a duplex or a single family. The duplexes are interesting because we're able to build those on infill lots in existing single family home neighborhoods. So a person who doesn't want to live in an apartment can live there, have their own yard, and they couldn't afford the whole single family, but to have half of a single family, basically what a duplex is, it makes a big difference. And the people are in great demand of rental in Central Florida there because of exactly what I said, Keith. The job source continues to grow in Central Florida extremely strong. The business incentives to come into the area by the local municipality is very, very good. So here's something interesting, Keith. The average salary in Ocala is about $72,000, and the average home price is about $298,000. That is a very healthy affordability.
4 to 1.
Yeah, very, very good. And so that job source continues to pay very well. And we've talked about just the logistics centers and the equestrian center that's the largest in the world now. The villages are just 25 miles south, so Ocala becomes a bedroom community, and that is the second largest retirement community and growing in the U.S. So there's a lot of job source that allows people to live there at a good affordability. And so that combination of affordability with this extending job source has been really, really good for the Ocala region.
It's been said that the only place you get money is from other people. And we're talking about your renters in this case. So oftentimes these renters, they have their sense of privacy there. Like, for example, do the duplexes even have fenced backyards for each individual side?
Depending on where they are, we will. Other times, it hasn't been a requirement. We've done lots of surveys to see, is it worth the price point to put in full fencing? In certain areas, it can be. In a lot of areas, Keith, they're just so excited with the price point, not having to move into an apartment building, that it hasn't even been warranted or necessary.
Yeah, so we're talking about livability characteristics here, because oftentimes new build rental property results in a higher tenant stay, that longer duration, because they're the first person that have ever lived there. And it's also difficult for them to go out and improve their living situation unless they become a home buyer. And that's difficult to do today. Tell us more about the incentives and the property types and so on, because there really are some pretty exciting ones.
One of the best things about Central Florida, Keith, combined with new construction, is insurance costs. Now, you and I have laughed about the blanketed statement where you said, oh my goodness, you cannot get insurance in Florida. You can't get property insurance in Florida, or it's doubled, tripled, gone up 7x. That is a true statement on certain properties. If you're buying older properties from the 1950s that are within a half mile of the beach on low-lying ground, but new construction properties far away from the beach, that is a totally different thing. So again, being in Central Florida where we are, a lot of people think, oh, to insure a single family home there, that's going to be several $100s a month. When actually, and you've seen a lot of our performa quotes, our insurance companies are getting a single family home done for about $65 a month on average. That's full coverage. And that's the advantage of new construction. Insurance companies are all about risk. They analyze risk. When you're on a new construction property built on higher ground, away from the beach, they like that and they do that. A duplex, you're looking at about $100 a month. So incentive-wise, we've really searched to team up with great insurance companies that get the best rates, full coverage. And again, we surprise people when they say, oh man, I thought there would be a whole nother zero at that monthly cost. Yeah. And these are actual quotes, as you know, with working with a lot of GRE people. So that's one great thing. Another great thing, Keith, that happened when we joined forces with Sumitomo. And again, Sumitomo, 320 years old, one of the biggest powerhouses out of Asia. Warren Buffett is very heavily invested in another one of their conglomerates, not the housing one we do, but he's very involved in one of their other companies. And when they came aboard, we have no bank debt for a builder, which is rare. And since we have such a healthy balance sheet, we're actually able to work deals with mortgage companies where we'll do what's called builder forward commitments, Keith. And that means we will pre-buy mortgages for our clients for the homes we're building, and we will pass that savings along. So right now, if an investment property in a duplex might be an average of 7% for anyone who walks in off the street to a bank, right now our most popular rate program for our investors for single family or duplexes is 3.75.
Gosh.
So as you know, for your 5 ways, if we want to get cash flow, there's a big difference. Yeah, we're getting affordable housing, but if the rate is over 7% compared to 3.75, that could eat up the cash flow. With us being able to have this power to buy large tranches of money and pass it along and lock our people in, again, an average right now at 3.75 is our most popular program, and that's long-term money. then we're able to get that cash flow right off the bat. And you and I know how important that is.
For this super attractive 3.75% long-term mortgage rate on single-family homes and duplexes, how much does the buyer have to come out of pocket at the closing table to buy that down themselves? And how much do you, the builder, participate in that buy down?
It depends, Keith, at different times because there is a little bit of a fluctuation. Sometimes it can be as low as 0 points or just one origination point to bring it in. It does vary. And also if people say, hey, I really don't want to bring in any points, well, that's fine. If you don't want to walk in 0 to 2% points for that, you can also just raise your rate up to 4.25 and probably walk in nothing. So there's different things that we can do, but the goal of it is to have us have the brunt of it. And what I can tell you is if the average person walked into a bank, and a bank wouldn't do this anyway, it's only for, again, builders with a certain size. But if you went into a bank right now and said, I'd like to buy my rate down to 3.75, the average, Keith, that this would cost a person off the street going into a bank would be 12 to 15%. Banks wouldn't even do it for an individual, but that's about the estimates when you look at it. So again, volume has privilege. The fact we're able to buy it down, it does cost us a good amount of money, but we're all able to save since we're kind of working together to buy these larger tranches. And again, the need of any investment for buying down the rate from the clients is very minimal.
Tell us more about the property types: new build single-family homes, new build duplexes.
Single family and duplexes are our main focus in 2026 for Central Florida. We've done the research. They're very high in demand. They rent quickly and they rent long-term to produce cash flow. Our average single family home under $300,000. We're aiming to, after expense, make about $300 cash flow. Our duplexes should be about twice that amount, about just under $600 a month or just over in cash flow. And then again, the prices are ranging from about $395 to $420 for a duplex. Again, these are in workforce areas where we're doing great scattered lots. Scattered lot means there's already existing homes around. We like to go to an area where there's a fundamental balance of homeowners and renters. So there's retail buyers that have bought their first home, and we will place our rentals in between them, whether it's a single family or a duplex.
We sure don't need to do a complete audio pro forma here, but those cash flow amounts, something near $300 for a single family home and about double that for a duplex, is that using, a bought down rate to about 4% and some of these other inputs you're talking about, like low insurance costs and a certain property tax rate? Can you tell us about that?
Yeah, property tax rate is property tax rate. We can get pretty dang close on property taxes, based on millage and get that down. But when we do our performance, we absolutely go off of, our average rate to be the 3.75 to 4.25. And then when GRE clients look at our performa and they look at the insurance cost, that's an actual quote from one of our insurance companies that has insured hundreds and hundreds of these properties.
Not a guess.
So they know what they're doing. So yeah, those would be the assumptions made in there. And that's what we're basically getting on a week in, week out basis.
That is really attractive. As we're talking about new build, I imagine there is some sort of builder warranty as well.
There's a state mandated 210 warranty. 210 warranty is something we could talk probably a whole episode on, Keith, but for what's good for people to know, basically what that means, you get 2 years coverage on the small stuff and 10 years coverage on the big structural stuff. And so that's why I like new construction. When I used to personally just buy my own fixer-upper turnkey properties from other people, I could get a 1-year warranty. And that's the best that really can be done. Now with new construction, we've gone from, with our fixer-upper homes, able to do a 1-year warranty, which is good. It's something. But now with new construction, we can do a 210 warranty. Big difference, and also really helps the safety score of issues if they came up.
We're talking about new build property, and we tend to project relatively low maintenance and repair costs for an obvious reason. Maybe your long-term vacancy rate could very well be lower as well, due to my earlier point about a tenant wanting to stay there for a long time because it's hard for them to improve their living situation unless they went out and bought their own place. And you have the low insurance rates and you have the low mortgage rates, all contributing to positive cash flow on a new build property. And when we think about that tenant and what gets the tenant excited, we start to think about some of those amenities. So tell us about what amenities are offered, including inside in the kitchen and so on, Jim.
Yeah, great question, Keith. We've really gotten a great recipe for success for that. We've been doing this a little over a decade now. And so you're always tweaking your build model. What do people like? What do they not like? What's good for durability? Let's look at maintenance and repairs. Let's look at turn costs. So our goal is always the dual focus. That's what looks good and what lasts really well.
Yeah.
Because you want durability when you have tenants. You want it to look good. So you sell it down the road 5-10 years to a first-time home buyer, it looks great. You can sell it. But durability-wise, you don't want a lot of extra expenses or maintenance and repairs, so we go durability. So what we found, a couple of things. I always joke about this. I do not like the word carpet, Keith. That is a terrible swear word in real estate investing. I can tell you right now, if I could go back, and this is not, owning hundreds of rentals, if I could not have done carpet and just reversed it to like vinyl plank flooring like we do now, or even tile, which was more, I probably would have been able to buy 3 or 4 of our duplexes cash.
Gosh.
With the amount of money I spent. And that is not an exaggeration. So we do not do carpet. First of all, it seems like trends are changing. It's not in favor right now. So we do vinyl plank flooring, which looks really nice, almost like wood floors. Super durable, though, for a young family that's going to be tenant occupied in your property and running around on it. That's great. Kitchen-wise, again, we don't sell retail really. We like to work with investors, but down the road, our investor might want to sell to a retail buyer. So we know, from our old fix and flip days of the FHA buyers, the kitchen's got to pop. So we always do, we don't do the white appliances, which, would save you quite a bit of money. It save us quite a bit of money. We do stainless steel appliances. We do all new cabinetry, kind of the latest, nicer cabinetry, a little bit of an upgrade. And then, butcher block countertops. Those are going to wear in about a year or two, Keith. It feels really good to spend that smaller amount, but we like to do the more durable, nice looking countertops, that are, just so much more aesthetically pleasing and actually durable as well. Same thing in the bathrooms. A lot of new builders will do shower kit, which not a problem if you're saving money on a rehab, but we would rather do tile, bring in the extra subcontractors to give tile. And then in the master, we do the dual sinks, which this might sound like little stuff, Keith, but these are the micro movements that help get a tenant in quicker, stay longer, and rent. So we're always trying to do these extra things, and the granite countertops, both in the kitchens and in the bathrooms. Those cost more up front, but we see for long-term of tenant, we see for the amount of rent we get, and for resaleability, because a lot of people don't think about that. What in 7 years you want to sell one of these properties? Well, it's a 7-year-old roof. It's 7-year-old plumbing. You're still in a great spot for an FHA buyer, and that aesthetically pleasing flooring, bathrooms, kitchens, that allows an easier sale for them because we want to look all the way around, not just a rental. I like to hold long-term, but if you want to sell in 5 to 10 years, that's a very valid strategy.
I like carpet in my own home, but not rentals. But what you're sharing with us, Jim, this is absolute gold that's been brought to you through experience, this over improvement versus under improvement line in rentals. And it really has a lot of balance between durability and price. These are the sort of things that really matter. But you are selling predominantly to individual investors, a lot of mom and pop investors. Why don't you make more sales to the retail owner-occupied market or to institutional investors, even though that might be cracked down upon now? But why don't you sell to those parties?
Yeah, Keith, I did a lot of fix and flip to FHA buyers, and I'm an investor. I really like working with investors. So when this all really went back to is 2009, I had a lot of investors. I was in Northeast Florida. The deal flow was incredible. And I just had a lot of investors, through my different networks and masterminds like where you and I have met and said, hey, you're getting great deals in Northeast Florida. Could you help put some together for me? And so I had done quite a few fix and flips to retail buyers, and it just kind of hot on me, way back then, like, wow, I like working with investors. I like building portfolios. I also like the fact that when I'm normally building a portfolio for an investor, well, they hang out with other investors and they're not looking to buy one property over the next 5 years. They're looking to buy 5 to 8 properties over the next 5 years.
Great point.
And so we just saw it as you got to like who you work with. Right? And nothing against first-time home buyers, but when I was rehabbing houses and selling them, golly, that was a lot of work.
And they could be persnickety, yeah.
Very persnickety. And so when Chris and I teamed up about 10 years ago, we had both gone through the same kind of aha, like going, yeah, it seems great, but you could sell for more to a retail buyer. But again, like I go back to even the type of property we build, we'd rather do a volume with investors, be a builder, buy investors for investors, and work that way. And I think it suits me. I think I would have probably hung up my shoes a long time ago if I was working with the amount of properties we've done with retail buyers compared to investors, honestly. And so I think it was just kind of it was a preference really that made sense.
To your point, investors buy multiple properties, and that way there are fewer parties to deal with, and investors tend to be less emotional than those more persnickety owner-occupied buyers. Well, Jim, you make it easy for investors. Besides all these incentives, you also offer an in-house management solution for these investors, often that tend to be out of state. Well, Jim, before I ask you if you have any closing thoughts, would you, the listener, like to ask Jim any question directly? Well, you can, because I have a great event to tell you about. Next Thursday, the 19th at 8 p.m. Eastern, Jim here and GRE investment coach Naresh will co-host a live webinar for Central Florida new build income property. And in fact, Jim, I think you've known Naresh longer than I have, as it turns out. But this event is free, and you, the listener, are invited. We've had between 250 and 550 registrants for our past webinars. Not all of them attend live. So the benefit of you attending live is that you can have any of your questions answered by either Naresh or Jim in real time. And besides learning about the Central Florida market and more about home building, you are going to see available new build income property, real addresses with some of these rather grand incentives that we've talked about here. You might end up with a long-term rate of about 4%. Again, it is Thursday the 19th at 8 p.m. Eastern. Sign up is open now at grewebinars.com. That's grewebinars.com. Any final thoughts here, Jim, for this great event coming up next week?
I think we're going to dig a little deeper. Obviously, this is a conversation that was great, but moves pretty quickly. When we talk next week, we're going to be able to dig into more of the fundamentals, some of the stats, and just get underneath the hood of why Central Florida is making so much sense and just some of the rising stars that we're seeing there that we're very excited to be a part of.
You've helped our listeners for close to 10 years now. It's been an informative chat as always. Thanks so much for coming back onto the show.
Thanks for having me, Keith.
Yeah, like our guest touched on, Ocala, Florida now has national recognition as the fastest growing city in America, and that's for the second year in a row, according to a new U-Haul report. Florida is, of course, a rather landlord-friendly state. In fact, Florida is the first state to enact a law that allows law enforcement to immediately remove squatters, distinguishing them from legal tenants. Now, here's what's interesting and why I've identified this opportunity. If Florida prices dipped because people were leaving, now that could be a red flag because population loss is like gravity. Once it starts falling, it is hard to escape. But that's not what's happening. Instead, what we're seeing is a temporary overbuild hangover. Builders got ambitious. We're in a brief period where supply outran demand and prices softened. That's not decay, that's a sale rack. Any vacant homes are not stranded, they're being absorbed by Florida's still growing population, which has now increased every single decade since its first census count back in the year 1830. Back in 1830, there were about 35,000 residents in the whole state. Isn't that amazing? Today, north of 24 million. That is 700x population growth in almost 200 years, and it's still growing. That kind of trend doesn't reverse because a few builders over-ordered inventory. Here at GRE, this made us target and find an opportunity. This isn't an accident. Central Florida is this year's most compelling housing market. In that region, Central Florida is growing faster than the rest of the state at large, and it really sits in the sweet spot of this temporary imbalance. One long-established builder overbuilt, and now they're motivated. They know what investors want. So, for example, they don't build swimming pools with their homes. They also offer property tours, and over 90% of their tour attendees buy property. They're willing to offer terrific incentives at our upcoming GRE live webinar. Like we touched on, new build single family rentals $270K and up, duplexes $395 to $420, long-term mortgage rates as low as 3.75%. You get low insurance rates since they're inland and new build, positive cash flow, and a builder warranty. At the event, you're going to learn all about the growth drivers in Central Florida, why so many renters are moving there, and see available properties. This benefits anyone looking for a clear, practical view of current real estate conditions. Joining live does matter since you can have those questions answered in real time, not after the opportunity has moved on. You're invited for next Thursday the 19th at 8 p.m. Eastern. This one is worth circling, not because it's flashy, because it's timed right. Sign up is open now at grewebinars.com. That's grewebinars.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.